All right, good afternoon, everybody. Before I get too far into this, let's make sure everything's working. If you don't mind just typing a Y there in the text chat or in the question box, I guess it is, and go to, and just let us know that you can see the slide. You can see our beautiful faces here, and okay, right, Renee, perfect. Thank you. Everything looks good, good. All right. So welcome everyone to today's exclusive webinar, Predictive AI for Dynamic Markets. My name is John Madison. I'll be the host here on behalf of FFR Trading. And we're thrilled to have you here for what promises to be an eye-opening session on how AI-driven trading can help you navigate today's volatile markets with precision. And the markets have been volatile. Before we dive in, just want to again thank you for joining us. Whether you're new to trading, if you're a seasoned investor, the insights you're going to gain today could make a huge difference in your approach to trading the markets. Topics that we're going to get into today, I'll cover the risk disclosure, obviously very important, introduce you to who we are here at FFR Trading and what our role is. I'll introduce you to Keith and Vlad, and we'll get the details on their Predictive AI for Dynamic Market program. And we'll have a market discussion and Q&A with Keith and Vlad after they're done with their presentation. And we'll go over the summary of the course details. They are what we call learn and earn programs. And again, that special bonus for everybody that stays until the end that you can be eligible for. All right, the risk disclosure, again, trading and investing in the financial markets involves risk. I think you all know that. While AI and data-driven strategies can enhance decision-making, no trading system can guarantee profits. Right? You should always assess your risk tolerance and consult a financial professional if needed. This webinar is for educational purposes only and should not be considered financial advice. All right, with that, let's get into who we are here at FFR Trading and what our role is here. At FFR Trading, our mission is to connect traders and investors with professional grade strategies that help them navigate today's fast changing markets. We work with industry leading traders to provide high quality trade alerts, market insights, and exclusive access to elite trading programs. Some of the people that you might deal with if you do give us a call. Michael McGinnis is the president and CEO. Some of you are familiar with him as he's been on these webinars before. And then the extended team, right? Some of the strategists, the portfolio strategists that will be working with you, the account managers, right? A great team assembled to help you reach your trading goals here at FFR Trading. All right. Let's introduce the participants here. We'll start here with Keith Harwood. Keith is a former Chicago Board of Options Exchange market maker. He's built powerful systematic approach to trading options. He's going to get into more of that. Keith, welcome.
Yeah, thanks for having me, John. Thanks for having me, and thanks again for all the attendees that have come in today. We've got a great group and we've got a great conversation to have. So I'm excited to talk through how Vlad and I have put together this exciting trading program.
Absolutely. This is a one-of-a-kind program, as you guys will see. And next up, Vlad Karpel. Vlad is the founder of Yellow Tunnel and a leading expert in machine learning and algorithmic trading. Vlad has developed systems that help traders adapt to market changes in real time. So Vlad, welcome. Thank you for joining us.
Thank you. Thank you for the opportunity, and I look forward to our discussion.
All right, fantastic. So we want to get right into, give people a reason to stick around here, and I think this will do it pretty well. We want to kind of give you a taste of what the academics of the program are and how it's performed. Again, these results here are based roughly on a $10,000 account size, allocating approximately between $1,000 and $1,200 per trade. These numbers are non-compounded. But first, I want to start with the academics of the program. Some of the key features, anyway. This program is a long only, so you're basically just buying outright call options, right? There's no put buying. There's no spreads, right? Just outright buying of call options. It uses 100% AI logic, right? Which I love. It focuses on highly liquid stocks and ETFs, so people are easily able to get in and out of these positions. It is mechanical and rule-based, averaging about 8 to 12 trades a month. Now, obviously, that can vary with market conditions. See, it is a long-only system, so it's probably done pretty well, avoiding a lot of this kind of downdraft that we've had here. And short-term moves holds for approximately 3 days, right? It's long on Tuesday, and then you're out Friday, and then you'll hold a part of the position till Monday. Is that correct?
Yeah, absolutely. So, as you noted here, we've actually been working on some modifications to the system in order to increase the performance as well as the win rate. And so now we've got a couple of little elements that we've realized are potential really great leveraged tools for us to use within the system. And adding that extra day does add a little bit of a kicker in some cases. So we have a 3 to 4 day holding period now, and the results, I think, speak for themselves.
Yeah, so let's get into the performance summary here. So you're averaging, right, 21% a month. Now, if you think about it, as a trader, most traders are looking for, if they can get a 2% a month, they're doing well. This is 21% a month. Those of you that are attempting to do this yourself, just kind of think of what these numbers would do for you, or if you're trying to build your retirement. What would an average 21% return do for your retirement, right? The average annual return now over 240%. It's winning 68% of the trades. The average winner is larger than the average loser. Nice healthy profit factor for those that break down these trading systems. You'll know that 2.57 is a good healthy profit factor. And again, average days in trade will be 4 days. Anything you guys want to add to either the features here or the performance summary of what you've been seeing here?
No, I think that really covers things pretty well here. And I think it's important to note that this is fully based on AI logic, so it's very rules based. It's not a discretionary system where somebody can, add in their own trading psychology and things to the trade. It's very built upon that systematic approach, which I think helps to remove some of the emotion from trading.
Exactly, which is fantastic for those of you that do struggle with that emotional component of trading. Think of what this will do when it's mechanical, rules-based, AI-driven logic. I think it's going to make a huge difference in your trading. The beauty is you're not just getting the signals, and we'll talk about the educational aspect, because Vlad and Keith are going to offer you a ton of education so you can learn from the ground up, right? It's only going to enhance the signal service. All right. Gone through the performance numbers. If there's nothing else that you guys want to share at this point, I know you're going to do a deeper dive into all this. So what I'll do is I'll get ready to hand over to Vlad. And Vlad, I'll make you the presenter, and you can share your screen. And then when we come back, we'll have a Q&A session with both Vlad and Keith. So get your questions ready. All right, Vlad, if you're ready, I'll go ahead and make you the presenter.
Sounds good. Okay, perfect. Can you guys see my screen now?
Yeah, looks good.
That's great. So to just give a brief introduction, we're going to be talking through predictive AI for dynamic markets today. I'm Keith Harwood, CIO with Yellow Tunnel. As you've met Vlad, he's the CEO and founder of Yellow Tunnel. He created the artificial intelligence behind the system that we use here. And after seeing what that artificial intelligence could do, I knew I really wanted to partner with him, use my options expertise, his machine learning and AI expertise, and see if we could create a really explosive trading system that had very well-defined risk, very well-defined rules, and really high leverage potential returns. So before we actually get into the system itself and how this came to fruition, a few disclosures as well. So on the next slide here, we've got the Yellow Tunnel disclosures. I know we've already done the FFR ones, but I always like to add in the Yellow Tunnel ones. So, options involve substantial risk, not suitable for all investors. Yellow Tunnel, Vlad, myself, John, nobody presenting here is registered with the SEC nor FINRA. So if you do have questions about your personal financial situation, you should consult with a registered financial advisor. The information that we present here is for education and information purposes only and should not be considered trade advice. And you should also note that anybody on this team may have a financial interest in the securities presented and the trade ideas. So you always want to keep that in mind as you evaluate any trade system for your own personal investment and trading portfolio suitability. And then I'll hand it over to you, Vlad.
Perfect. Again, thank you very much for joining. A few items to discuss today. First of all, artificial intelligence behind the paid program, very important, because there's been a lot of innovation, especially in the past, couple of years in terms of ChatGPT, and now, there's a different models out there that Meta has, and Google provides Grok, which I really like, that feeds into Twitter and other data that has been trained. So there's a lot of innovations, kind of exponential innovations that's happening in the past few years, which is important to discuss. One is why use options. Keith will spend some time giving you some of the advantages and why use options, especially in the current market environment. We'll do some data analysis behind the trades. We'll do option analysis, how to use some of the Greeks or some of the gamma exposure and positioning that Keith and I are using a lot in our live trading room and in making decisions behind the trades, right? Because it's very important to have AI and giving you signals, but you also need that human component to make sure that these signals are valid for the current market volatility and environment. And we'll go over trade examples, and I'll discuss latest news that drive the market. So again, artificial intelligence is extremely important. I think, as I said, in the past couple of years, there has been a lot of advances. What I'm excited about is that I've been doing this for close to 20 years, some of the original models. Actually, in my master's degree in computer science, I was specializing, and I wrote a research paper on artificial intelligence, which was a few years ago. But as I said, the progress has been exponential in terms of neural networks, in terms of machine learning, and some of the latest advances. So we do use neural networks. We learn and train on the data, but what I'm getting excited about is that the AI itself now can determine, let's say, cluster analysis, which stocks move in high correlation to each other, or which stocks have the best model. So our approach is to have AI determine, to classify all the liquid stocks that have option data. There's a universe of about 2,000 stocks that have liquid and have options data, to cluster them in certain groups, and then find which models, because all the large companies like Meta, Google, XAI are now providing these libraries for machine learning and for finding new neural network models. So we first do a group analysis, find the stocks that belong to this group, and then AI determines, based on the back testing, which models are the best suited for the stocks, and then once it trains on the data, it makes a decision on what to trade. Right. So artificial intelligence is behind all of the signals, and then on Sunday, Keith and I, we analyze these signals every day, and then based on also overlaying with the options data analysis, we make a decision on Tuesday which trade to take. So that's extremely important.
Perfect. And then, taking some of that background of the artificial intelligence and the data analysis, we then move into the options side of things to define our risk as well as leverage the potential upside. But options do have additional risks that any trader should keep in mind. They do often have higher transaction costs than a stock trade. There is assignment risk with short options. Now, with the paid system, we don't have to worry as much about assignment risk because we're only using long call options. But some of the ideas that we discuss in our live trade room and through the educational process will include short options. Now, you can get assigned. That'll generate a different margin requirement and a different risk profile than a short options position. So you got to always have that in mind as you're trading any more complex option strategies that involve short options positions. The long options also decay. So options are effectively an insurance product initially, using puts to hedge a long stock portfolio. Those insurance contracts, as time passes, have less value because there's less time for them to become an in-the-money option or a further in-the-money option. So it's not a whole life insurance, it is a short-term insurance contract or leverage contract. And the amount of time left in the option defines part of that value. One of the other things that can be a kicker for us, or a potential negative, is that volatility element. Volatility is the unknown about that future realized volatility of the market. Now, implied volatility tries to estimate it and predict it, but this is also changing constantly. It can go up as people are buying options or seeing big movement. It can go down as people start to see reasons that the stock or the market may start to calm down. And that can also impact the value. Increases in volatility increase the value in general, decreases in volatility decrease the value. There are other risks to consider, but these are the main ones for us to focus on today. And now with that, let's get right into what a stock payout looks like as a relative basis. So the baseline for a lot of traders is stock. If I have $100 stock and I think it might go to $120 in the next month, a 20% return, that may or may not be rational or reasonable for a big ETF like the S&P 500, but there are many names out there that have that kind of volatility and have seen that kind of volatility to the downside over the last month. Now, if I'm looking for a 20% potential return and I buy 100 shares, it's going to cost me about $10,000. And I have a potential for a 20% return if I hit my price target. If I say that I want to stop out of this position, the market's telling me I'm wrong. If I've lost 10%, then at $90, I want to get out. But I can't always get out. You have a stock that has a fundamental input, whether it's more macro related like tariffs or DeepSeek AI had a big impact on a number of stocks, or earnings. That can cause the stock to gap below my target exit range, and I may actually be in a situation where I lose more than the $1,000 I was originally targeting. And that's where options start to kick in. So as you go to the next slide, we can look at the payoff of a call option position as an alternative to stock. Now you'll note here that there is this sort of hockey stick type formation where we've got more upside in the case I'm right and limited downside if I'm wrong. Now, of course, I do have to achieve an upside move for that call to pay off at expiration. Now the call gives me the right but not the obligation to buy the stock at my strike price on or before expiration. So if I'm looking at the $100 call in my theoretical stock here and it's trading for $5 per share, one call option will represent 100 shares and will cost me $500. In order to have that defined risk and that leverage, I've got to pay a premium. But if I'm still willing to risk that same $1,000 max loss, I now have the opportunity to buy two of these call options for $1,000 and control 200 shares of stock. So now my upside at $120 price target puts these options at worth $20 a piece, $2,000 times two. So $4,000 minus the initial premium paid of $500 twice, so $1,000, and I have an upside of $3,000 instead of $2,000. My downside, if we drop drastically and I wake up tomorrow morning and this stock's trading $60, well, I can only lose the premium I paid. Because if I don't think that this is a good buy for $100 a share when it's trading $80, of course I'm not going to exercise my call option. I'd rather go to the market and pay $80 a share as an investment than exercise calls to buy the stock for $100 a share. Really, it's a trade-off thing. And on the next chart, you can see where that trade-off exists. If I'm looking for the upside on the right-hand side of the chart, you can see that I've got that leveraged component. I've got a multiple of the return. On the downside, I am capped at $90. Ultimately, though, there is a trade-off between $90 and $110 per share. So under $110 per share, the stock would have performed better at expiration. Above $90 a share, the stock would have performed better at expiration. Below $90, my risk is fully defined. I can sleep better. Above $110, I'm getting a leveraged return. I can get excited about my potential investment account growth, my trading account's growth. Now in our system, we don't look to hold these options till expiration. We're on average about a month out. So this full decay does not hit quite as hard, and it ensures that we don't take that cap loss. We've never had 100% loss. I don't know that I can say we never will have one, but it seems very unlikely when you're dealing with options that have about a month expiration. All right. So further, why we use these options on the next slide, they provide this significant leverage opportunity where I can put $1,000 into call options instead of $10,000 into the stock. I now have the opportunity for more portfolio positions and more leverage, or having cash on the sidelines to act when the market starts to get a little bit clearer to me in my system. I have an increased exposure by owning outright call options than owning shares of stock. It costs a fraction of the amount. That's my leverage component. My max loss is the premium I'm investing in the market. So that's my defined risk. So if I combine all of these things together, I can start getting a leveraged opportunity when the market signals are clear for that leveraged need or that leveraged desire. And I've defined my risk. So I'm really utilizing proper risk management tools now. This is like the best of both worlds when done appropriately in terms of position sizing and risk management. It gives me great leverage and great defined risk. And for a short holding period, I'm not experiencing that full decay. All right. And as we go through this, there's further options analysis that goes into this system. So this is a traditional skew chart. This is from the S&P 500. Sorry, not the S&P 500. This is from an individual stock, and you can see a pretty traditional skew chart here. It's a smile. The cheapest implied volatility in the market tends to exist on slightly out of the money calls. That means that the leverage is cheapest for slightly out of the money calls and more expensive on the downside. The market has a tendency to drift higher or gap lower. We talk about a lot, the market likes to go up the stairs and down the elevator. That's that high risk scenario where we start to fall, but I can utilize that when I see a stock that has a high probability of an upside move using these AI analytics that Vlad has created and developed over 20 years. And I can use these slightly out of the money options to give myself a better leveraged element when I'm looking for that potential upside. And that's what we started to incorporate more into our option strategies, is using slightly out of the money calls as a way to reduce the needed move to generate a significant profit. Now, furthermore, as you look at the term structure, we do a further evaluation on that, and that's this is the VIX yesterday. Now, the VIX, when the market is noisy like we have right now, we see spot VIX, the expected realized volatility for the S&P 500, higher than in the future. The VIX, the implied volatility, the realized volatility has a mean reverting characteristic, where when the market is noisy, options for the short term are very expensive. It's a very random walk based scenario, and we could have just big up and down moves like we've been seeing. As you go further and further in the term structure, we start to see an expectation of a return to normalcy. So these noisy periods are priced into the market, but the expectation of a reversion to traditional market returns is also priced into the market. And this, again, factors into our decision-making point. Do I want exposure to the random walk of the short-term moves, or the longer-term or medium-term predictable artificial intelligence generated signals? And how do I leverage that the best? So all of this goes into our thinking as we evaluate how best to incorporate options into these potentially very dynamic markets. All right. With that, a few recent trades that we've had in the system. So even with this market volatility, we are seeing some really good short-term moves that can be leveraged with these options. Citigroup was a prime example of that. In mid-February, we started to see a lot of investment flow into the financials as we approached the market highs that were made on February 19th. A few days before that, we had a long signal in Citigroup. The stock was trading at about 80 bucks a share. And if you go to the next slide, you can see the general leveraged return element of Citigroup. By entering on February 11th, exiting the position, half the position on the 14th and the other half on the 18th, it was roughly a 5% return of the stock, a very significant move for a financial. The March 21st, 2025, $82.50 calls, which expired at about 5-6 weeks later, would have started at $1.88. So $188 per contract, and generated 115% return in 3 days, or 102% return by exiting actually on Tuesday, because Monday the market was closed. Now, this is actually where you can see a little bit of that decay because the stock didn't move over the weekend. The options decayed slightly in value. Still, both legs of that long trade generated over 100% return. All right. On the other side, sometimes we do see some losses that come in, and this is where risk management really kicks in. Williams looked like it was generating a potential for a long signal, showing some support there at the 50-day moving average, had a series of selling, likely a larger investor reducing positions on Mondays starting in November, and then again in December, and then again the second week, excuse me, of December. And we were getting these bounce backs from Tuesday through Friday. So it looked like a pretty solid signal, but at the end of the day, on Friday, we did have a little bit of a dip. So over that time period, the 3-day hold, we can see the stock dropped by about 1.5% in 3 days. And because options are a leverage contract, they generated an 18% loss in 3 days. It's not ideal, but when we see winners over 100%, losers can never get to over 100%, and traditionally do experience losses that are a fraction of the total value. Finally, I did want to look at one more trade here for you and explain a little bit more why we made this modification to hold through the Monday. eBay was a prime example of this. They had an announcement of a partnership with Meta, Facebook, back in early January, caused the stock to spike. We had a pull back down, and we had our long signal on January 21st. The stock chopped a little bit through the week before actually taking off on Monday. Now, a lot of times when we see this chop, the market will effectively price that in. And what we saw in eBay was actually an increase in the implied volatility through the week as people started to increase their bullish leveraged positions heading into the end of the week. Mondays aren't, the weekend doesn't always work, so we still trimmed half the position from Tuesday through Friday. And you can see that with the stock from Tuesday through Friday, it was down slightly. If you go to the next slide, we can get some of the numbers here, Vlad. We had a stock entry and a loss of 1.6% in the stock over that 3-day period. However, the options actually broke even. This allowed us to say, well, there is still money flow going in here, some excitement in this market, a break even in 3 days, but holding over the weekend flipped this from a 1.5% loss in the stock to a 1.5% return in the stock, and turned the break even on the options to a 100% return for the other half of the position. Net, a very solid win, and you can see now why I think why we are now utilizing some of these out of the money options and pairing it with this tranched selling approach where we can generate great returns, but reducing the size so that we don't have max risk for the weekend. All right, and that's just a few of the prime examples of paid, and we have a full track record that we can obviously share with you guys. Give FFR a call, and they've got that in their hands. And then with that, why don't we go to the current market conditions and all the noise that we're seeing, Vlad?
Sounds good. Thank you for that presentation. And again, I want to go over now current market and some of the tools that we are using on Yellow Tunnel. So this is aggressive power trader. This is an example of neural network and the model that actually runs every day. And that's why it says aggressive, which one of the models we're using to make predictions. So today, actually, there were no signals, bullish signals, because market has been under pressure. But looking at the spiders, you can actually see the model predictions, basically saying, listen, if we reach 560 today, and these predictions were posted last night, this is potentially an overbought conditions, and this is why you want to maybe trim some of your position. Whether you're day trading and you want to trim at 560, or if you're deciding where do I want to enter long or short. Right? If we do drop to 547, then this would be a buy signal for the market, based on the model's prediction. So you can see between 547 and 560, this is more than 2% difference. So this tool alone can help you make a prediction and help you optimize your entry and exit prices. And if you just imagine if you can save 1 or 2% on your entry and exit price, how it compounds over time. And again, this is something we're using in our analysis. And then we have long-term prediction. Model basically says that it's been such a strong move to the downside that a lot of the short-term momentum indicator are pointing to the downside. But if you look at the predictions for the next 2 to 3 months, it still sees that the long-term trend is intact. This is, at least as of right now, 10% pullback in S&P and over 10% pullback in QQQ could be considered as a healthy pullback consolidation, and at least for now, model does see momentum to the upside. Obviously, model doesn't know about tariffs. It doesn't know when will it be 20% tariffs on Canada? Will it be 50% tariffs on European Union? So market does not like uncertainty, and there is a lot of element of trading psychology that we also use in our live trading. But you can go into AI analysis and type in any symbols, right? NVIDIA is probably one of the popular signals, and then you can also find the prediction for these stocks. Sorry, I probably logged out because I talked too much. So do it again. And then, yeah, so if you go to AI analysis section, you can enter any symbols, right? Let's say NVIDIA. Also caught my attention that 10 days, it see a lot of momentum to the downside, but longer term, we still see that the uptrend, in the next couple of months, as we approach in the next earnings cycle, that the NVIDIA can continue going higher. And a lot of people ask me, how is it possible that in the next 10 days, in the next, going into the March expiration and going into the earnings season, NVIDIA can reach a 90 level, but 2 to 3 months it could reach 123. Well, because market doesn't move in one way. Short term, you can have a momentum to the downside, but long term, if the long-term trends, if you look at the monthly chart and weekly chart, the trend is intact, then the stock could continue going higher. So looking at the spiders, you can see some of the information that we're looking for, not only the AI signals, but if you superimpose with macroeconomic conditions, right? I do have, and Keith have a lot of the top to bottom approach. So we look at the interest rates, right? The yield has dropped significantly from 4.8 in the beginning of the year to almost 4%. So that's bullish for the market usually, right? Unless it's a rapid sell-off that indicates that the probability of recession is increasing, which if you're a bear, that would be your explanation. If you're a macroeconomist or if you're a bull, you would say lower stable interest rates is better, right? And you can see that the housing activity is picking up slowly as a result that the 30-year mortgage is at multi-months low. Same could be said about the dollar, right? Sharp pullback from 110 level. Everybody was worried about tariffs and superinflation, and now dollar significantly dropped, which is also bullish for the market. Usually, when you have dislocations or you have a recession, usually dollar is considered to be a safety asset classes. We do look at the high yield. So the high yield did pull back in the past couple of days, but still above 200-day moving average. So you start seeing widening of the spreads between the treasury and some of the junk bond market, but still stable. And we can see maybe some of the signs of exhaustion on the volume and spikes in VIX, where we got to the 30, where it could show you that at least short term, maybe the sell-off is overdone, right? And this is wave A, B, C. So it looks like wave A is coming to an end. Usually there is wave B rebound, maybe to 580 level, maybe to 590, and then another wave down after maybe March expiration, right? Next Friday we have March expiration, we have Fed decision next week, and then in the beginning of April we have decisions on tariffs on Canada, European Union. So combination of all these macro and microeconomic conditions can cause the market to bounce back in a V-shaped recovery, or just like the model said, that potentially if the news are negative, right, and let's say we impose 50% tariffs on Canada or on European Union, then we are breaking. If you look at the longer, if you zoom out and look at the, let's say, monthly chart I just analyzed, right, if the probability of recession start increasing, we could revisit, the previous cycle highs, right before the 2022 when the interest rate went higher, right, we reached 480. We broke through that in January of 24, and we've already retraced half of these gains. So if the 540 and 530 levels don't hold, that opens the door to 500 or potentially as low as 480. 20% sell-off, we had that sell-off in 2018, and that's something that, when Powell came out and said we're going to start raising interest rates in 2018, market did pull back 20%. So, but that doesn't mean that this uptrend from the 2020 is broken. We're still trading in a strong uptrend, but 10%, 15%, 20% pullback, it is something that can happen as a result of the tariffs and some of the inflationary pressures in the market. And obviously we're looking at our friend Bitcoin as a popular proxy for risk taking, right? And we can see a lot of downward pressure from 110 to almost 75,000. So pretty sharp pullback in high beta across the board asset classes. And lately, even in the equal weighted S&P, you can start seeing more, kind of classical wave A, wave B, and now probably wave C that's putting pressure on the market, because the value stocks like consumer staples held up pretty well, but now we're coming to probably close to the end of the C wave in the equal weighted S&P and low beta stocks in general. So all of these discussions you can see in the live trading room. This is the performance of live trading room across all of our models. These are actual trades. This is not just an AI signal that I put in Excel spreadsheet. These are actual trades that you can see in the live trading room. Keith and I lead these. We have 1 hour of the morning session when the market opens and the last hour. And you can see performance of all the trades, 83% winning percentage trades. Here you have combination of stock trade, option, and option spread. Paid program is solely on option trade, but you're welcome to participate in live trading room where we talk about all of our programs. And if you have, and this is one of the advantages of live trading room, that when the market continues to go higher, well, it's relatively easy to make money, right? And you just buy and hold, right? But when the market pulls back 10%, 15%, 20%, this is where trading psychology is very important, right? And this is something Keith and I talk about, not only the option analysis in terms of term structure or gamma exposure, or where the positioning is, or to which strike the market could be pinned, but also concepts like game theory, prospect theory, recency bias, which are very important to at least recognize and discuss in a live trading room. So these are some of the topics that we cover on a daily basis. And now I'm going to turn your attention to Keith training course.
So in addition to that, we obviously understand the importance of education on all of the option strategies and the technical formations and everything else. Now, Vlad's got a great background in the artificial intelligence side of things, and he can explain that a lot better than I can. But what I try to do is explain to people further how they can understand why behind what we are looking at in terms of whether it's the paid program or the live trading room. Why would I buy options? Why would I sell options? Why would I go out and put that exposure there instead of the simplest version, which is stock? Further on, talking about that market psychology, that is a huge element for traders. And so this 12-part trading course goes through 12 roughly hour and a half video sessions to talk through what a professional options trader and a professional trader can look at in terms of how to approach the market. When we want to use verticals, condors, butterflies, straddles, strangles, any number of complex strategies rather than the simplest version of stock or outright calls. Further, we go into a dive into skew strategies that can trade skew on more of a delta neutral basis. So maybe with a directional bias, but having a little bit less exposure to the day-to-day noise. And then finally, of course, one of the most important elements, if not the most important element, I think, to most traders, is understanding risk management and position sizing. At the end of the day, we are all going to experience losses in our trading accounts. It's how we manage them to ensure that that doesn't wipe us from the market. Because if I take a 60% loss in my portfolio, I now need a 250% gain on my residual portfolio, 150% gain on my residual portfolio just to get back to a break even. So I don't want to have a situation where I'm taking a 60% drawdown and need 150% to get breaking even again. Now, finally, what we're all here for, let's talk a little bit more about the weekly paid trading signals. We have options ideas that come out every week. We had it set up with a Tuesday closing market near the close entry, and actually modified that to Tuesday morning in order to add a little bit more time for those out of the money options. We've got real-time signals for entries and exits. We've got these weekly market video updates, live trading room, as Vlad had discussed before, weekly live strategy events, trend analysis videos, trading discipline videos. There is so much content here for you guys to understand the market and how we are looking at it as a way to really predict the next move. And again, these are the results that John had mentioned before, very significant. And actually, one of the things that I think is really crucial here is to look for an analogous situation to what we've seen before. Now, back in August, we had bad non-farm payrolls, and from July 16th till August 5th, we had about a 10% drawdown in the S&P 500. Coming out of that bottoming action, we saw significant returns in the market and ultimately a new high. After a 10% drawdown in the market, new highs. Paid experienced a 10% drawdown in the portfolio, so in line with the market drawdown. But the next month, from August 16th till July 13th, we had a 73% return. During this latest 10% drawdown in the S&P 500, we've had an 8% drawdown in paid. So it's not exposed to the market in the current noise and looking for that bottom. And once that bottom is found, we have explosive potential for an upside if it repeats. And one of the things that I think we all look for in the systematic artificial intelligence technical analysis is that options don't, or the markets don't necessarily repeat, but it remembers. And it looks for ways to repeat to a certain extent or mimic previous behavior. And that's why we look at all those technicals. And so right now, I feel like the timing is a great opportunity during this drawdown to find some of these really great leveraged ideas as people start to reallocate to the great ideas that they see after maybe an irrational level of selling off. And that's where we sit with the paid system. You know, if there are any questions about paid, you can always ask us right now. Otherwise, you can always email us after the fact or email the team at FFR, and we can always answer questions then. But I think with that, maybe we open it up to questions Q&A here.
Absolutely, and fantastic presentation. Both Vlad and Keith, appreciate that. I mean, there's so much there. From, you know, the AI analysis, where you can literally just punch a ticker symbol in there and let the AI do the heavy lifting and give you those buy and sell points and predictions as to where that stock is headed, what the long-term views are. That alone is worth the price of admission, right? Vlad, you got into an overview of the markets. That was, you know, fantastic. You know, everything from, you know, the majors from the SPYs to Bitcoin, the VIX. And hopefully maybe you'll do a little bit more of that as questions permit. The trading room, again, this is just another bonus on top of the paid signal service, the predictive AI for dynamic markets service that you're offering today. The trading room is coming with that. The options course, Keith, I've sat in on some of those sessions when you recorded that in front of the live group, and what, you know, valuable information, guys. If you're looking to learn the options market, who better to learn from than a former market maker at the CBOE? I don't think you get any better than that. Again, that's like a $3,000 course that they're offering for free as a bonus for the paid system if you subscribe. All right, let's pick up some of the questions as folks are posting them here. Let's see. I want to go back to somebody had posted a question in the beginning for the Q&A. And this is Daniel wants to know, with the tariffs seemingly changing by the hour and the resultant downward pressures on the market, have you given any thought in adapting the paid strategy to buy puts?
So I can touch on that briefly, and then Vlad, you may have more thoughts on this, but we've generally found that the predictable level on the markets and the better signals have been on the long side. We do experience drawdowns, but they can be violent. Throughout this pullback, we have seen really big ranges and positions getting maybe looking bearish, and then the next day the market's up 2%. And then the next day the market's right back down 2%. So these big ranges have been a little bit less predictable. Over the long haul, we do tend to see that reversion to the mean and a little bit more normal behavior and allocation to maybe new names and ideas as a result of that new fundamental input. Since all of this is kind of built on that technical analysis and what we feed into the system, trying to predict the next fundamental move can be very difficult. So what we prefer is to look at the more predictable elements of the market, which comes from the technicals and when money flow is going back in.
All right, fantastic. And Chuck wants to know, with a bullish bias when buying calls in your service, could you possibly do a bull put credit spread on the same stocks also?
Yeah, so with a credit spread, it can work. We do a lot of that actually with the live trading room. With the paid system, we found that the better returns come from the long outright options, particularly on this bull side, because the market tends to undervalue those calls for these short-term moves. That's where we get that big leveraged component. There is defined risk elements to a credit spread, of course, but it's going to be a lower return rate, higher probability, lower potential return. All right, so if you have stability in the market, you still win with a put credit spread. What we're looking for is that upside, and that gets best performance out of an actual long outright call.
All right, and James wants to know, do you combine technical indicators along with the AI for the predictive AI program?
So I can take that one. In terms of AI, we train on the price movement, so open, close, low, high, and the earnings data, right? So that's what the model is being trained on. It trains on different technical data. But in the live training room, we do superimpose that with the look at the macroeconomic data, but we also look at traditional technical indicators like gamma exposure, term structure, and the options data, and some of the moving average, Bollinger Bands on the main ETFs.
All right, and Lisa wants to know, how do you choose your expirations when only holding the position for a few days?
Yeah, so we do it very systematically. We're always looking at the monthly contracts. The greatest liquidity tends to be on the monthly contracts, as well as some of the short-term weekly options. The short-term weekly options do have the most leverage, but they also have the greatest decay. So to balance out that probability of success along with the directional bias, we found that generally looking at roughly 4-week out options has been the best performance for the system. To each their own. Some people really love trading weekly options. Some people really love trading leaps. The balance of liquidity for the relative move on a leap and a short-term holding period doesn't necessarily pay off. But when you start looking at those 1-month options, you do tend to get significant liquidity and a good balance with that leverage, defined risk, and lower cost entry. I mean, it allows for access to stocks like, Netflix, that I wouldn't be able to allocate a $1,200 outright option, $1,200 to an outright option, or $1,000 to an outright option if I was trading something 9 months or a year from now. I can actually access that and generate some potentially leveraged returns by looking a little shorter term.
And one final question I'll get in, Don wants to know, would you have picked NVIDIA as a trade today? I don't know what you guys did in the trading room this morning.
Actually, did talk about NVIDIA, and one of my favorite strategy when there is a lot of uncertainty, market volatility, would be mirrored puts, right? So if you think that you're not sure whether this is going to be a 10% or 20% correction, then buying put and buying stocks does make sense. And you can see, I mean, by now maybe most of the gains are gone, but I think this is one way you can hedge your position and express your bullishness position long term, right? If you think 50% correction in NVIDIA is good enough, but there's more downside risk, then you just buy a put to hedge.
All right, and just one last one. I'll sneak this one in before we have to move on for time's sake. How far out of the money do you buy?
Yeah, so traditionally just a little bit out of the money. So we're looking at, if it's a $116 stock like NVIDIA, if we were looking for something there, we'd be looking around the $120 calls. So something that has a good balance of probability of success plus that leveraged return. You know, sometimes people look for that super bullish case of a recovery to $150 and start looking at cheap options. Those just don't give the great probability of success. Yes, they can hit the home run, but we want to have a good balance that gives a little bit of both, the best of both worlds. So slightly out of the money, something that I expect to be in the money if the predicted move comes to fruition. So, you know, thinking if you're like delta focused, like a 40 delta call can really generate some good returns with balancing out some of the upside leverage.
All right, excellent questions, guys, and great answers and follow up there. All right, let's move. Let's tell folks everything that comes with the service, because there's a lot of stuff. There's a lot of stuff I want to go through with you guys here. These are what we call learn and earn programs. So it's not just trading signals. There's educational, obviously, a ton of educational material that comes with this. So let's kind of break this down here. Obviously, you do get the trade alerts. Those will be sent on Tuesday, exiting on Fridays and Mondays. All right, so held for only 3 or 4 days. And the alerts are sent an hour before market close. So you get the alerts, when to get in, when to get out. The daily trading sessions. So members are able to log into the Yellow Tunnel trading room and learn, right? Charting, the live trade setups that you guys give, trading psychology, you know, your analysis on the overall market, options analysis, right? A lot of stuff going down, both in the morning and in the afternoon session there. You have complete access to Keith and Vlad's trading team via email or phone, so you can contact them and their team if you have questions. Keith went over his complete 12-session options education course. This is a course that we did over a series of 12 weeks, I believe it was, when we recorded that. So you'll have access to that, which is a phenomenal, like I said, that's a $3,000 course right there. The weekly market video updates. So you get Vlad and Keith's insight into what's going on in the markets on a weekly basis there. And again, access to the Yellow Tunnel trading room. That's a huge opportunity, you know, for additional success, you know, above and beyond just the signals from the AI. And of course, the AI analysis that they'll have access to. They can plug in a symbol and have the AI analyze that, give them points of, you know, potential entries and exits, trend, and all that. And then also for those folks who don't have the time or time management available to self-trade these signals, we do have access, or you do have access to third-party registered brokers. All right, so basically you would have an account and the broker would be authorized to execute the trades on your behalf. Right, so that's if it's something that you say, I don't have time to be there to execute these trades, right, you can have that done for you. And then again, you get access to us here at FFR Trading. Again, our role, really, we're trying to build you a well-diversified portfolio of strategies. You all know that one single strategy alone over time is going to have, you know, peaks and troughs, right? They're going to have drawdowns, right? So we build a portfolio of non-correlated markets, you know, different traders, different strategies to help smooth out that equity curve over time. All right, anything, Vlad or Keith, you guys want to add to what comes with the paid program?
I think this is a pretty good job of showing the comprehensive stuff. Vlad, I don't know if you have anything to add.
No, I think this is a pretty good overall overview. Thank you for all the details.
Yeah, and I think you guys did a great job also of kind of going over this step by step. What we're looking for here at FFR and what Keith and Vlad are looking for. We are looking for you. If you become a member, we want your story. How did you find us? How did you find Vlad and Keith? And then as you get into the program, provide us your monthly account statements, right? One, because we want to track your progress, right? There are things that we can do if we need to make changes, but we won't know how you're doing unless you provide your brokerage statements, and we can review those with you. And that will be a quarterly meeting that you'll commit to. So we can sit down with you, go over that portfolio, see if there's any adjustments that need to be made, right? Hopefully everything's going as planned. And then if you're satisfied, right, provide us a testimonial. You can go onto our website, ffrtrading.com, and you'll see plenty of testimonials. You can, search the Google reviews. We have a very high rating on Google as well. And then obviously, if you have success, share that, let other people know, right? That's what we're looking for and what Vlad and Keith are looking for from their members. So this is what we've got, the offer that we have for you today. And this is good for the first 10 members only, all right? We're not looking for a ton of members. We can only have, there's only so much support staff available that Keith and Vlad have to support new members, right? And they can't have everybody taking, so many people taking the same signals. It can affect, the institutions get wind of it. That wouldn't be a good thing. So if you sign up for Keith and Vlad's program, a one-year program, you'll receive a second year for free. And Keith and Vlad are also offering a $1,500 credit, right, towards the purchase of that one-year program. Again, the bonuses, right, Keith's 12-week option course, again, that's valued at $3,000 alone. You get access to the live trading room, the Yellow Tunnel live trading room that Vlad went through. And as an even further bonus, they're giving you access to the Yellow Tunnel Aggressive Power Trader for 6 months. That's valued at almost $600. That's the trade recaps, the weekly videos, the watch list trades, the weekly newsletter, trend analysis videos, a lot of stuff that goes with that, including the signals. All right, what you have to do. We just can't accept everybody. This is limited, and also we have to make sure that you are a good fit. Again, here's the options program, just an overview of that. I think Keith did a really good job of covering what is in that program. All right, so everything pretty much from A to Z you need to know about options is going to be in that course. All right, again, the live trading room, you see the performance there. Vlad showed us updated performance numbers. So that, again, if you call us as well, we'll go over the program details since inception, how it's performed, all those numbers we're going to give you. But you do have to call us, right? We do have to make sure it's a good fit for you. We're not just putting anybody in these programs. It has to make sense for, based on what your goals are. So if you give us a call, the first 10 members will get access to all these bonuses we just talked about, but you call us at 800-883-0524. Right, if you're outside the US, right, as some of you are, you can use the 737-292-4425. If you have to, you can email us at support@FFR Trading, and a strategist will get back to you as soon as possible. All right, but give us a call so we can go over the program, all the details, the performance, right? So they'll give you all the updated performance numbers for the program since inception, so you can see those numbers for yourself. But you do need to call us and to be able to take advantage of that. Again, these spots will go fast, tremendous amount of value here. So give us a call, 800-883-0524. I'll leave those numbers up here, and the 737-292-4425. Before we wrap up, again, I want to thank everyone for joining us today. Keith or Vlad, do you guys have any additional thoughts that you want to share with the viewers today?
I think from my perspective, the unique proposition, what I'm super excited is that, I mean, there's, just like John said, there's other services out there, you can diversify, but the unique proposition that we have is that you have combination of someone like me who comes from the technology side and who build AI and networks, right? I mean, I've been managing my own money for many years, but I don't have the experience or background that Keith brings to the table. So I think our system is unique in that regard, that, two brains are always better than one, but these two different backgrounds is exposure that is going to be very hard to find. And we always wanted to try to level playing field and run our services as a hedge fund, right, where you have a lot of people collaborating and providing software solutions and AI analysis that before would only be available to our larger hedge funds.
I think that's a great point, Vlad. I mean, I think one of the things that a guy told me back when I was working for a hedge fund, he said that if you have one edge, that might be worth 1 point, but if you have 2 edges, that's worth like 10. So it's not just an addition, it is an exponential potential benefit by having multiple edges in the market. And I think that's something that we have brought together really nicely here. And I hope that you guys can see the benefit and the power of combining a couple of different approaches to the market that are very synergistic. So I think it's a great program.
Absolutely, and guys, think about, you know, adding the dynamic duo here, Vlad and Keith, to your portfolio. What would that do for your portfolio? What would that do for your retirement? You know, I was reading an article that said about the average 50-year-old in this country anyway has about $30,000 saved for retirement, right? You know, getting 10% in the S&P over the next, even 30 years isn't going to cut it, right? If you don't have that much time, you're going to have to be a little more aggressive. This is a great way. You got two top professionals in the industry that are showing you how to do this, but you're also getting the live signals where it's actually done for you, right, as you start to learn yourself. This is a great way. Like I said, a learn and earn program is the way to go. They're managing the risk for you, taking all that emotional pressure off as well. So guys, I really want to thank everybody again for joining us today. And as promised, again, everyone who stayed until the end here will have access to the free educational trading package from FFR Trading that Keith and Vlad put together. Again, just call that same 800-883-0524 number or the 737-292-4425 number, and they'll get that sent out to you. So we appreciate you staying till the end. Again, spots are going to fill up fast on this, so don't miss this exclusive opportunity to trade smarter with AI. Thanks again, everyone, and we'll see you guys inside the program. Take care.
No, thanks for your time. Everybody's time. Thank you.